deal. Well, joining us now is Tim Evans from Longleaf Trading Group, joining us live from the CME in Chicago. Tim, hello to you. Just wanted to get your outlook firstly on this shift in outlook that we've seen on oil. Focus now really turning to non-OPEC cuts.
Hi, Natalie. Nice to be with you today. Yeah, I mean, if you kind of look at the price action that we're seeing in crude, I mean, we kind of have to remember, the ranges that we are working with before the deal was reached on November 30th. We had that high of 52.5. We had that low, approaching that $40 level. And the market has really just recovered what it had already priced in. What the market is ultimately going to have to see for us to break through that $52.5 level and establish another leg higher is the market having full confidence that each member of OPEC that's subject to the terms of this deal is in fact going to comply. The history of OPEC is rich with non-compliance, virtually with every deal that existed before 2008. So we're going to need to probably see some evidence that members are in fact complying, and the market's in full confidence of that ultimately to take out the levels that we're seeing. So, I don't think it's any surprise that we're stalling here back at that $52 level until we see some of that happen.
Now, traders on Wall Street seeming to enjoy the fact that the spotlight is on political moves in Europe for once instead of in the US. We've seen US stocks move higher off the back of that Italian referendum vote. Also significant moves in the euro, and also seeing the US dollar index remaining relatively at par. Give us your outlook on these events.
Yeah, I mean, the one thing that we have to remember, Natalie, is this was not the Brexit vote. The word no and European governments, that combination, brings a lot of anxiety, or it was bringing a lot of anxiety to investors around the world. But the nature of this vote were very different. The question that we really should have been asking is, what does the world look like with a yes or no vote? There was a lot more uncertainty with a yes vote than there was a no vote. What would the future of the European Union look like potentially if the Italian government, had more control to get things done faster? We know kind of what status quo looks like. So we initially saw that anxiety on the vote, but I think the investment community really began to ask, all right, well, what in fact are we really dealing with here? The facts of the matter are that the Italian government or Italy as a nation, it would require a constitutional amendment for Italy to leave the Eurozone, which, again, at that point would make it similar to the Brexit scenario. But with the no vote, it's showing that it's very difficult to pass a constitutional amendment in Italy. Therefore, that concern, if it was going to be one, is not going to be on the forefront in the near future. So, really the European Union as an institution, in my view, is actually stronger today than it was before this vote. So I think the movement that we're seeing in the euro currency versus the dollar is the market expressing that exactly.
Absolutely. There were comments coming through from some of the ECB officials overnight saying that the Italian referendum was very separate to the Brexit vote. They fall into very separate categories in terms of constitutional reform and subsequently what it means for the Eurozone. Just shifting themes slightly, though, Tim, it does seem that there's not really a lot of new themes coming through for markets. I mean, obviously, we're seeing the Dow Jones hitting another all-time record today, certainly setting the S&P and the NASDAQ indexes up also for perhaps their best day in around a fortnight. But not a lot of new material for traders to be working with. Is this something that we see sort of continuing on and on and on over the next couple of weeks until perhaps we do get President-elect Trump's inauguration, or can we expect to see some new themes edging in the lead up to Christmas?
I mean, all good questions. The thing that we've really truly been dealing with since the election is hope versus reality. We understand kind of what the global and economic environment looks like. With Trump getting elected, it brought all these new ideas of infrastructure spending and corporate and individual tax rate reforms, and all things that would potentially, allow inflation to kick up and business activity pick up. But the reality is Donald Trump's not going to be taking office till January 20th. And the likelihood that he gets all these policies done on day one or some of them at all, the market is now questioning that. So I think the market priced in hope to a large extent, but now we're looking at reality that nothing truly has changed. And what is the likelihood that all of this that we've already priced in will change? So I think the markets are kind of stalling out, having to accept those realities. So I think for a lot of this to continue, we're going to have to see progress made. We'll have to see the Trump transition team, discuss, potential deals that they're working on with the incoming Congress, and ultimately what those first 100 days are going to look like, when the Trump administration actually, begins to govern. So, yeah, the next couple of weeks, I'm not expecting this, this inflation trade to really continue. I think, again, very similar to the oil situation we just discussed, we're going to need to see some evidence before the market's willing to take us to, to new heights.
Absolutely. And in fact, we have, Tim, seen some commentary coming through from some Fed policymakers on this, which I just wanted to guide you through a little bit and guide viewers through also. We've had the New York Fed President William Dudley coming through, weighing in on President-elect Donald Trump, in fact, saying markets are volatile. It's best to watch economic news. Also adding that it's unclear what fiscal policy will come, how big it will be, and when it will occur. Assuming the economy stays on this trajectory, I would favor making monetary policy somewhat less accommodative over time by gradually pushing up the level of short-term interest rates. Also, Tim had some commentary coming through from Chicago Federal Reserve Bank President Charles Evans, saying that we are on the cusp of a period of rising interest rates. The markets are seeing reasons for higher interest rates. So certainly, Tim, as we know that December move from the Federal Reserve is very, very much priced in. Does this at least give us some level of clarity in terms of what we could be seeing in terms of both economic and monetary policy moving forward?
Well, the thing about it is, the members of the Fed, they don't have any better information than we have. They have to speculate in order to coordinate monetary policy, what ultimately fiscal policy is going to look like. The thing that people don't really seem to be focusing on, and I think should focus on more, is let's go back to 2009 when Barack Obama took office. He pushed forward a major stimulus plan, and Republicans in Congress were very resistant to that. He was not able to get the size and scope of the plan that he wanted at the time. This is why the details differ some. The principle is the same. That Donald Trump wants to dramatically increase government spending with government infrastructure projects, the same exact ideas that Republicans, who now have a greater share of the U.S. Congress, did not like before. So what's really going to change? Is all of a sudden the Republicans in both the House and the Senate, going to now favor big infrastructure spending projects? I think the answer to that most likely is no. So how Congress responds to these ideas and the policies they're actually able to implement largely will help dictate the conclusions the Fed draws in terms of drawing up monetary policy for Q1 of 2017. So there's a lot of things yet to be determined that we're ultimately going to see as again the Trump administration begins to govern.
Absolutely, and we will certainly be yet to see if markets have gone too far, too fast, as was suggested earlier by Alan Nuckman. Tim, we will have to leave it there. Thank you so much for your time.
Thanks, Natalie.